Hello everyone, my name is Keith Mader. I'm joined today by Nick Borg. Nick is a real estate loan origination supervisor at WECU. He has helped countless individuals find financing for their ideal homes, and he's going to share his wealth of knowledge today in this conversation. So Nick, thank you for joining me.
Thanks for having me, Keith. It's great to be here.
Yeah, so we're going to talk about the housing market. Why don't we just start there, kind of at a high level. What's going on in the housing market today?
What is going on in the housing market today? There's a lot going on. I'll try to keep this brief. But today we're seeing, it's a higher rate environment than what we were seeing in 2020 and 2021. This has brought down demand from buyers because there's an obvious affordability crunch. We're also seeing a low level of inventory in many areas. Interestingly, we're seeing lower rates today than we were 1 year ago. So that has brought up demand marginally compared to last year, but it's still an environment where I think a lot of buyers are sidelined because of the affordability crunch, kind of just waiting to get into the housing market. So it's creating an environment where buyers who are in play are being a little more selective and taking their time in their decisions. And then sellers have to be very strategic in how they price and market the house if they want it to sell.
Yeah, that's awesome. So I guess, given that, would you say that it is more of a seller's market or a buyer's market?
We're at a point in time here, again, October 2024, where it's hard to say if it's a buyer or seller's market because it depends on the listing. If you're a seller and the house is turnkey in a highly desirable area, it's selling quickly. But if there's just a couple of maybe things that are less attractive, I don't know if that's the right way to phrase it, but homes are sitting a little bit longer. So I'd say as a buyer right now, if you can afford it, it's a great time because competition is less. We're not seeing the bidding wars.
Right.
But as a seller, I think it's just all about strategy. You want to be confident and work with your realtor to list your house at the right sweet spot to get attention, but to still maximize what you're going to get from the sale, right?
Yeah, that makes sense. So you have people that when rates drop, they can finally kind of afford, because obviously the interest rate is impacting your payment a lot.
Yes.
So you have people saying, oh, okay, I can finally afford a mortgage that I think could get me a house. And then you have all the people that, they're ready to swallow that painful, taking it on a higher rate mortgage. And they're like, okay, it's lower now, even though it's still worse than what I have. I need a bigger house. And so I'm willing to increase my rate by 2%. So you get people from both ends of things jumping in the market. Is that accurate?
That is absolutely accurate. Yes, a psychology thing is one. For some reason, if we get to a point where it goes from 7.25 in rate to sub 7, and so if it starts with the 6, that 6 handle, this really spurs movement and thoughts for people getting interested. And hey, maybe it's decreased enough for me to take a look. So that's where that 1% decrease in rate that gets to that that flood of buyers that typically comes after that.
It'll be interesting to see what happens as things change down the road. So kind of speaking about those first-time home buyers, I know one question I had when I was entering the housing market was like, how much can I actually afford? It's kind of, you can do calculators online, but it's kind of sometimes hard to know. So what would you say, what's your piece of advice for that?
To what you can afford, if you were to do this on your own, one rule of thumb is to look at your gross monthly income and then take 28% of that, and your mortgage payment shouldn't be above that number. That is the rule of thumb that has always played a part in the process. I think if we were to look back at this moment now with an more unaffordable market, there's likely people going above that, but that is a good place to start.
So gross meaning this is pre-tax?
Pre-tax,
yeah.
Yep, pre-tax before the government takes their cut. But yeah, 28% has been the general rule of thumb. I think that's bankrate.com is a good resource on that.
Good place to start with that number. Cool. All right, and so again, kind of more first-time homebuyer questions. Let's say you're trying to get in the market and you're like, okay, well, what if I wanted to buy into a condo? Maybe there's a lower purchase price available for a condo or a townhome. Would that be a good starting point if someone was just trying to start building some equity, or what are your thoughts on that?
It can be, yeah, a condo or a townhome. The benefit could be a lower purchase price, which means less money at closing, so your down payment can be a little bit lower. So it's a good place to start. I'd say an important factor to look at is your long-term plan, and then also there's specific condo rules and regulations and monthly dues. So you want to factor that in. So if there's an expensive monthly due for a specific condo, that may offset some of the benefit of a lower purchase price. So they're all different. So I'd suggest working with a loan officer to come up with that plan.
Kind of like if you're looking at a house and you're like, oh, why is this house priced this way? Well, maybe there's a big HOA on that, and that makes the price go from beyond just the list price to your monthly payment kind of increases with the HOA.
Exactly.
Gotcha. All right, so another question I had, final one, kind of when we're talking specifically about first-time home buyers, is I know that one thing that prevents first-time home buyers from getting in the market is that they're just not really sure how much cash do I need to have in my bank account before I'm ready to, make that purchase. So what's a good rule of thumb for money that you need to have for whether it's down payments, closing costs, how much is that going to be? What are your thoughts?
Where to start? A good place to start is a lot of minimum requirements for many programs is 3% down. So 3% down of the sales price would be the down payment requirement. There are grants and other options for down payment assistance that can help with that. But the 3% down is a good place to start. And then having another little chunk of money for closing costs, which can be $3,000, $4,000, $5,000 to $10,000 if you want to buy your rate down. So we can get into that later. But 3% of the purchase price, and then $5,000 to $10,000 for closing costs is a good place to start.
I know for me, when we were we researched forever and we were playing on the calculators, and then eventually I was like, okay, well, let's just talk to somebody. Let's just talk to a loan officer. And I felt like that was like the most helpful thing ever, because I was like, oh, look, real numbers. It's like so much more helpful.
Well, today there's so much information out there.
Yeah.
TikTok, Google, YouTube, it's hard to know where to start. And so with all of that, there's a lot of good information, but a lot of maybe misinformation too. So I can't recommend enough just to reach out to a mortgage professional to come up with your specific plan, because that likely at least will point you in the right direction and get rid of all that extra kind of noise when you're not sure where to turn. Yeah. So then you can continue to do your own research, but more intentional about it maybe.
Yeah. And I know at WECU, like, if you're like, I don't want to like talk to somebody if I don't even think I'm even close to being ready. I just want to, but I want more information. I feel like people shouldn't feel bad to say, hey, I don't know even if I'm close. Can we have a conversation? WECU, we're totally open to having those conversations, right?
It's never too early. So we do, phone consultations, Zoom, in person. There's no cost or anything like that. Just hit us up if you have any question. We can schedule something, and it's a perfect place to start. And no, there's no too early or I'm not ready yet, because what I've found, most people feel like they're not ready. I didn't feel like I was ready when I made the jump and actually bought a home. So that's normal.
Yeah, that's super helpful. All right, so moving on to kind of a more existing homeowner question. What would your advice be to someone who maybe their house doesn't really fit their needs, but they kind of want to maybe add some more square footage to their existing home? What's the best product to finance that sort of thing?
There are a few options in that situation. So if you've got equity as a homeowner, home equity line of credit is a good way to go, or a cash out refinance. So those two products allow you to tap into your equity and use them for things such as home improvements. There are also renovation loans that we offer, and those are good if you don't have equity, and so you can finance those renovations specifically with those programs.
Okay, some starting points, things to look into. So I have a couple of fact or fiction questions. Okay. So just things that I may or may not like spend some time on social media, and to your point, you're seeing there's so much information out there. You're seeing people come up and they give you tips about real estate. So I want to run some of these things that I've seen past you.
Sure.
So the first one is, so if you're an existing homeowner and you make an extra payment on your mortgage every year, does that really shorten the time that you're that you're paying on your mortgage? Is it really that impactful?
That is a fact.
Oh.
So the specifics are going to be different for everyone, depending on where you're at in your loan and what your rate is, things like that. But yes, even a small extra monthly payment or yearly payment can make a significant difference in shortening the amount of interest you pay or shortening the term of the loan.
Okay. So you're potentially taking years off of your mortgage.
Absolutely. It can be years, and it doesn't take much to get there.
Yeah.
So, yeah, quick phone call, and we can run the specific numbers and really get detail-y on that one.
So if you get a bonus every year, you get a tax return. If you throw that at your mortgage, you're maybe cutting years off of your total period of your mortgage.
Yes, you are. Mm-hmm.
Cool. All right, here's another fact or fiction. I've heard that for certain loans, it's possible to get rid of PMI without refinancing.
That is a fact.
Oh, okay.
So for conventional loans, if you have gotten to the point, typically 20% equity in what you owe versus what the value of your home is, we can run the numbers, order an appraisal, and potentially remove PMI. So that is a fact.
Oh, do you wanna say what that is?
PMI, private mortgage insurance. So it's a payment within your payment that protects the lender. PMI allows you to buy the house with less than 20% down, but doesn't really do much else for you as the consumer. It protects the lender. So getting rid of that quickly is ideal.
Wow.
And absolutely worth it.
So you have to pay for the appraisal and it's certain types of loans, and then potentially you'd be able to get rid of that expense every single month.
Yes, so small expense for an appraisal, but then looking at what you were paying for PMI pays for itself pretty quickly.
Gotcha. Great. Awesome. Well, some very helpful tips there. My next question is something that you hear about a lot these days is people renting out their current home and then buying something else. So, we, for example, have kind of what you would consider a starter home, and we're like, we've had a couple kids, need a little bit more space. I guess, what's that process look like at a high level, and any words of advice on that?
It is an option, certainly an option to buy and rent out your previous home. It's not for everyone. I think renting, that's something really to look into to become a landlord. It's not all rainbows and unicorns, but it is certainly an option. What that allows you to do is keep building equity in that home that you still own, that you're leaving, have somebody else offset your mortgage payment, which is great, and still maintain ownership of that house. So that can be a stepping stone, but what the benefit of potentially selling could be is using that equity for the down payment for the next house. So that may go further than you think. So looking at those numbers, really considering what you're going to rent your house for, and the overall financial picture is key for that, but it is certainly an option.
So for something like that, you're not able to get the first-time home buyer program, and I know a lot of times people use the equity from their first home and then roll that into the down payment of the next home. So is that 20% for your next home, or?
Good question. Buying your next house, you're not a first-time home buyer anymore, so it's a minimum of 5% down for conventional loans. So keep that in mind. A lot of people do think it's 20% down. You can do it with 5% down. So if you've got that and the numbers work, then renting out your house and you can swing the payment at 5% down for the next house, then absolutely, that's a great option for you.
Awesome. Very interesting. All right, so just one last question for you. So obviously, WECU, this is a WECU video. What is your sales pitch for WECU? What's your elevator pitch?
I like that question. Thanks, Keith. At WECU, I think it's important to note that we're a members come first credit union, right? So we offer personalized mortgage options, competitive rates and fees, and knowledgeable loan officers. So we are happy to meet with anybody, no matter where you're at in the journey, and come up with the roadmap to home ownership for you specifically. And we're excited to get that going for you.
Yeah. I think one thing that a lot of people don't really know about that kind of makes WECU stand out against a lot of the other mortgage lenders is that we always retain your servicing.
That's huge. That is a big one.
Because I've heard of friends that they'll tell me like, yeah, I worked with our real estate agent. They recommended we go with this lender, and now my home is owned by Golden One Pacific whatever. Like it's like a random company they've never heard of.
Loans.com or whatever, and it's a phone tree you have to kind of navigate to figure out where it's at.
Yeah.
Yeah, that does not happen at WECU. So yeah, we retain the servicing, meaning that your payment is always made to WECU. So you call us if you have a question or you need to make adjustments. We're the go-to for the life of the loan. So
yeah. And I think that's interesting because, you know, when you're buying a home, it's a period of time where you're searching, you're signing the loan papers, maybe this is like a year process. But then you're in this loan for 30 years potentially. It's a much longer it's a much longer relationship than just the buying part, right?
So the servicer matters, right?
That
is a big factor in the majority of the time you have the loan.
I agree. Well, Nick, very much appreciate your wisdom and your insights, and appreciate you joining me today.
Thanks, Keith. Happy to be here.